Alrighty, greetings everybody. Welcome back. Another wonderful Wednesday discussion in store for you guys. It is currently Wednesday the 14th, and we are ready to rock and roll. We're going to dive on into things. Today, we're going to be taking a look at the top 3 off-brand charting styles. This is relevant to the different charting options out there. And just a quick little preface, in case you guys can't already hear it, it is storming cats and dogs out there right now. So I am currently at the mercy of the gods or whatever it is you believe. But point is, it is getting wild out there. So if you guys can hear the storms or the lightning, I apologize. I don't, at this point in time, have the technology to control the weather. So we will just have to make do with that noise. And if I get disconnected, guys, you know why. Hopefully I didn't get, didn't have a tornado drop down on my head or something like that. But anyway, guys, so without further ado, we're going to dive on in through some disclaimers. I'll read through the first one for you guys just to get my voice box warmed up, and then I will leave them on screen and let you guys kind of have at it. Actually, as a matter of fact, let's switch now. I'll just leave it on screen for you guys. Sometimes I feel like an auctioneer when I get going through these, so I'll just let you get at it. Same disclaimers as always. Not a single word has changed, so if you already know them by heart like I do, well, don't worry about finding any new information because it's exactly the same as what you remember. So, but nonetheless, just going to leave them on screen for a brief moment. Then we will dive into the material that follows. Moving along. And keeping it going. There's a good boomer there. Onwards. We're almost there, folks. Just one more after this. Okay. Final one. You guys have made it to the light at the end of the tunnel. It's all fun and games from here on out, right? Alrighty. So getting us started off, that's an odd noise, just the keyboard making some strange noises there. Getting us started off, guys. I hope everybody's having a nice Wednesday. My name is Chris. If you haven't met me yet, I am a presenter and trader as well as mentor. That's the word I was looking for here at Earn to Trade. Many of you guys have already met with me. So, hey, how are you doing? It's a pleasure to see all you guys again, as always. But without further ado, guys, we're going to go ahead and dive on into things. The goal of today's webinar is to talk about the top 3 off-brand charting styles. We are going to relate them to the most common charting style, which is just time charts. So you could say that we're actually covering 4, but it's the focus is going to be to kind of compare and contrast the differences and maybe potential uses for you guys of the other 3 that we will be mentioning. This is something that is definitely relevant to your trading, because if you're someone that just trades on time charts and have never really played around or read too much about the other options out there, this might be interesting for you and hopefully informative, and giving you a new insight into some of the tools that are available for you to use on pretty much most charting platforms that you may not even be aware of, and you might be interested in seeing if they help you find a better view of what's actually going on in the market from a technical analysis perspective, because they all do provide very different readouts on what's actually happening, because they're all based on different things, so to speak. So without further ado, let's go ahead and switch on over to those wonderful Finamark charts here. 1 second. All right, there we are. So currently what we're looking at right now is the Euro Forex futures. You can see it up here in the top left, and it says 5 minutes underneath it. Well, what does that 5 minutes mean? Well, that just simply means that each bar, each block that you see on your screen, and once again, if some of you are already aware of this, please be cognizant that not everybody has the same beautiful amount of experience that you have. So you may hear some things that and you may hear some things that you don't. Either way, it's all good brain food. But nonetheless, guys, each bar on the screen currently represents a period of 5 minutes. A new bar is plotted every single 5 minutes. So if you want to say, oh, I want to know what happened at, say, 1 o'clock. Okay, I'm just going to go over here to this 1 o'clock bar, and I'm going to look at this, and I'm going to say, all right, well, I know at this point we have an open, we have a high, we have a low, and we have a close. Okay, it might be hard for you to see all those things. If I were to zoom myself in here, it's going to make the bars look real funny, but it might make it a little bit easier to see on the eyes. But once again, with all time charts, everything is based around time, as you would expect. So each candlestick gives you that information of open, high, low, and close. It lets you know where the market opened at. If it's a bullish bar, it's going to open always at the bottom of the big fat body. Okay, so the big old fat body down here, which is called a candlestick, the bottom of it, okay, is going to always represent the opening price. That's going to let you know where price started during that time period, okay, that 5 minutes. Like I said, this one we're analyzing is 1 o'clock. So we're going to say, all right, well, at this time, the price opened here at, say, 1.11720. We know that just by looking at this. And we can say, oh, well, the high of this candle is going to be the highest point that this candle touches. Now, this does not have to be a fat part. In this case, it actually happens to be one. But the high will always be just the highest point of the candle, right? That's going to be true regardless of whether it's a bullish candle or a bearish candle. Okay, now bullish meaning we're closing going upwards, making positive gains, or bearish meaning we're closing downwards, making negative gains, so to speak. If we're assuming we're not shorting the market, generally indicated by red and blue candles or green and red. Either or, red is generally the universal bear color. All right, so we have the open, we have the close, which is, we have the open, we have a high, but we didn't talk about the close. The close on a bullish candle is always going to be the top of the body, okay? It's always going to be the top of the fat portion, all right, for the bullish candle, all right? For a bearish candle, it's the opposite. That's what the color comes in to let us know the direction in which the rules apply. With a bearish candle, it's always going to be the bottom of the body of the big old bearish red candle, all right? The high is always going to be the highest point the candle achieved. The low is always going to be the lowest point the candle achieved. So just real quickly to speed on through this, guys, just as a nice little refresher and, providing some contrast for the things that we're about to talk about. Just remember, guys, the open, the close, the high, and the low is what's provided during a period of time by time charts, okay? So we're going to use that information, and we're going to kind of contrast and ping off of it as we go forward. But that's what we've got here. Now, these are very, very popular charts that are in terms of usage. I would definitely argue, I don't have any exact numbers for you, but I would definitely argue that time charts are the most popular trading chart by a vast margin in terms of the retail trading world. But There are still quite a lot of other options out there that are utilized. Some people might use time charts in conjunction with other charts, like the ones that we're going to be mentioning. And that brings us to that portion of where we're going to be mentioning those things. So let's go ahead and see how we're going to do this. Now, using the Finamark platform itself, giving you guys a little tutorial here on how to get to, because we have made some recent changes, how to get to the part that I'm about to talk about. We're just going to click the cog wheel up here in the top where it says show chart settings. All right, almost sounds like a tongue twister. So we're going to click the show chart settings. After we click that show chart settings, you'll notice down here on the bottom left, it says series type. All right, series type. It currently says time because that's what we were starting off on. That was our ground zero. That was our base. That was what we were going to contrast everything to. If we click on the arrows over here, you're going to notice a few other options. And these are the ones we're going to be talking about today. We have tick, we have volume, and we have range. Okay, if I want to go to tick charts, I'm going to click on the tick option. All right, and just like that, you can see in the opaque, kind of blurry background, you know something has changed. Well, let's go ahead and close by clicking on the cog wheel again. And let's see what we've done. All right, well, all of a sudden the charts look different. And actually, let's go back real quick. We did change it to tick, but notice what happened over here on the right side. Okay, it says series size, and it says 233. I can type any number in this box, okay, that I want to type in, and that will be the size of each tick chart bar, so to speak. All right, that's going to be relevant here in a second, but let's go ahead and give this the backdrop, and we will begin our wonderful story. And I'm going to take some notes for you guys on screen as well. So we're going to say charting styles. We're going to start off with just a quick little recap, which time, bars, referees. I don't need to capitalize everything. All right, so what I wrote down, just a quick little note to get us caught up to where we were. I just wrote time bars represent a time period displaying OHLC, open, high, low, and close. That's what the time bars display in regards to the information, okay? So don't be confused with anything else. We will get through things. But that's the information that's provided to us during a period of time. It displays those things. And that is the long story short of what a time bar is. Now we have tick charts on screen. And tick charts, guys, tick charts are interesting, okay? Tick charts are interesting. Let me move my bar there. All right. So tick charts give us another look at the market. They give us a bit of a just an alternative way of measuring and analyzing the market instead of the time interval basis like we were just talking about, okay? So the interesting thing about tick charts is they display a number of transactions, all right, in terms of ticks, all right? And the reason that this is beneficial to us, and I'll just actually write that down. I wrote set by the trader there, guys, drawn based on a number of ticks. And I wrote set by the trader because it's important to understand that we can set the tick charts to whatever it is that we want. All right, any number that you want, any number of ticks that you want, you can set it to. So you are the pilot in command there. You are in control. Okay, so taking a look at tick charts, and we'll kind of maybe move this to the side a little bit for, well, let's go ahead and leave it there and then move it off. All right, so tick charts are beneficial to us because they allow us as traders to gather information about market activity just in a different light than the time charts. So since tick charts are based on a certain number of transactions per bar, we can see when the market is most active or sluggish and barely moving. All right. So for example, one bar will print after, say, 233 transactions, which is what we currently have. These are trades that occur on a 233 tick chart like we're currently displaying. So in the top left, you see it says 233. That means each one of these bars didn't print until 233 transactions took place, okay? So these transactions include small orders as well as large block orders, all right? It doesn't care which. It's just saying small orders, large block orders. Whatever happens, we're going to count it as a transaction. When 233 transactions take place, we're going to print a bar, okay? That is essentially, in the long story short, what a tick chart encompasses. All right, so the value in that to us as traders is it's very easy to see when the market is active or when it's not. And the reason is, if you're basing the drawing of a bar based on a number of transactions taking place, and you look at the charts and you notice that bars aren't being plotted very frequently, it's kind of seeming to take a while because it's not based on time. It's pretty easy to tell that the market isn't very active, and maybe it's not such a great time to trade unless that's the type of conditions that you're looking for. But it becomes very easy to identify when there's little to no volume in the market because, once again, if all those transactions are taking place, the bars aren't being drawn. The bars don't care on a tick chart how much time passes. Theoretically, it could take all day to draw one bar if you were to put your tick chart, obviously, to a high enough number of transactions, or the market was just flat out slow enough. So that's the value there in the tick charts, whereas with a time chart, sometimes it's difficult and can be misleading on how slow the market is, because no matter what, if you're on, say, a 5-minute chart, on a 5-minute time chart like the one we were previously analyzing, on a 5-minute chart, it's going to plot a new bar every 5 minutes. It's always going to be plotting at the same speed. It's always going to continuously plot based on time, and time never stops. So that can be misleading to the naked eye or to a new trader in general, because you're seeing stuff plotting and you think stuff might be going on, but it's going to plot no matter what. So the way we analyze whether or not there's a lot of volume in a market when we're using a time chart is a little bit different than simply looking at a tick chart and saying, okay, well, obviously there's no volume because there's no bars being plotted. So that is something interesting that, that makes, or I guess, contrasts to the time charts, and the reason why tick charts in and of themselves are interesting. Now, something else that I should mention with the tick charts, each transaction is counted just once, regardless of the size. Okay, so remember I said that with a tick chart, it's counting the transactions, and it includes small orders as well as large block orders, okay, all at once. It includes both of those, and each transaction is counted once regardless of the size. This is important because as we move on to volume charts a little bit later on, you'll understand some of the differences here, as well as range as well. But nonetheless, so each transaction is counted once. It doesn't care how big the order is. Every order is an order. That's the way tick charts work. All right, think of it that way. So conversely, to more bars being, to bars not printing in a slow period of market when there's low volume. So when there's not many orders coming through, we were just talking about how the market might look like it's not even printing anything. Well, conversely to that, what do you think happens when the market is active and there's a lot of volume? Well, when the market's active and there's a lot of volume, more bars are going to print. It's going to print like crazy, especially if you have your interval size set to, a low number, say like 233 is relatively low. So if you go even lower than that, say 100, you're going to have bars printing just left and right. It's going to be getting crazy during a high period of volume anyway. So that is essentially the long story short on a tick chart. And the interesting thing about tick charts is the most interesting thing to remember about tick charts, or valuable thing I should say, is that they provide a logical way to measure market volatility. Okay, they give us a very clear, defined way to pay attention to how much volatility and volume is actually really going on in the market in terms of just action. All right, we'll call it volatility more so than volume, but nonetheless, it gives us a very clear indication of what is actually happening without having to dissect it, without looking at anything else. Whereas with time charts, we might have to analyze a little bit deeper because the number of bars that are being printed is always going to be exactly the same, and it's always going to occur at the exact same speed, no matter what, no matter how active the market is, no matter how much volatility there is. So I'm not saying that you can't figure out the volatility conditions and volume conditions with time charts, but tick charts are an expedited way, for most traders anyway, to see that information. So, you know, unlike time-based intraday charts like we were talking about, so time-based charts based on a set number of minutes, say 5 minutes, 10 minutes, 30 minutes, or 60 minutes, tick chart intervals can be based on any number of transactions. And frequently, the interval of tick charts is derived from Fibonacci numbers. Okay, so that's another cool thing to remember. So with tick charts, a lot of times the numbers that people use are Fibonacci numbers. Okay, there's those magical Fibonacci numbers coming back in. And if you don't know what Fibonacci is, it's just simply the sum of the two previous numbers in a sequence, adding up to create the current number plus the previous, and so on and so forth, repeated, repeated, repeated. So some popular intervals based on this series include 144, 233, like we currently have displayed, and 610. There's a lot of other intervals that people use as well, but that is the story behind tick charts and why they might be interesting to you. Now, we're going to use something that is similar to tick charts, but gives us another view based on a different rule set. And to do that, we're going to switch our charts over yet again. And instead of being on tick charts, we're now going to go ahead and move down one tier, and we're going to click on volume charts. And just like that, in the background, you notice some things have changed. Okay, so if we go to tick charts again, just get if you guys just kind of look through that opacity, blah, 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 I can't talk this morning, opacity there, you'll notice that as we go down here to volume, you are seeing some noticeable changes in terms of what is being drawn. Okay, so here's tick, here's volume, here's tick, here's volume. Okay, it's a little bit different, but let's go ahead and take a look at what we got going on here. All right, so currently we've got some volume charts on. Now, what are volume charts? Well, volume charts, and let's go ahead and give ourselves another note here, shall we? Keep that note taken going. Okay, so volume charts, what I wrote down is based solely on the number of shares or volume that is being traded, okay? So based solely on the number of, or the amount, oh, I have two ends there. My typing skills are probably the only thing that are worse than my speaking skills. So I just want to take this moment as a brief little commercial break to remind you guys that I thank you for bearing with me despite my continuous struggles to use the English language. So thank you very much, everyone. But volume charts based solely on the amount of shares or volume that is being traded. That's what we want to understand. Okay, whereas tick charts are drawn based on the number of ticks, and once again, that is a number that is set by the trader, just like the volume, just like the tick charts. We once again can set this, okay, I'll just add that. We can set the preference, obviously. I don't know of any chart options out there, so this is going to kind of be redundant. I don't know any chart options out there that don't allow you to adjust any settings to them, at least in some degree or some fashion. But once again, volume charts are based solely on the amount of shares or volume that is being traded. These bars, what we're currently looking at, these beautiful volume bars, may provide even more insight. So they might provide even more insight. So jumping into the juicy material right away into market action, because these bars represent the actual numbers that are being traded. So similar to tick charts, we can examine how fast the market is moving by noting how many and how quickly these bars are being drawn. So they gain some of the same benefits in relation to time-based charts, over time-based charts anyway, that tick charts do. And the fact that, once again, when the market is slow, and you're not going to see bars being drawn as quickly, and when the market is very volatile, we're going to have a lot more bars being drawn. So once again, the nice thing about the time, or in relation to time charts, volume charts are a very easy way to see the amount of volume that's going on in the market, the amount of volatility the market is displaying, okay? So if we look at this chart as an example, because we have 100 here as the default, which is a it is a small size for volume charts, but nonetheless, relatively speaking, one bar will print after every 100 shares have been traded. Okay, now in terms of what we're currently looking at being Euro Forex futures, that means one bar is going to print after 100 contracts have been traded. Okay, so whatever it is that you're analyzing, it is going to be relevant to 100 of whatever that is. So if we were actually looking at Forex itself, okay, if we were looking at Forex itself directly in terms of, spot Forex, it would be 100 lots have been traded. All right. If it was a stock, it would be 100 shares. If it's futures, it's going to be 100 contracts. Make sense? So we can set that to how many of a specific number of something that has been traded before a new bar has been plotted. So each of the ones on your screen right now have only been plotted after 100. In this case, because we're looking at futures, I keep wanting to say shares. After 100 contracts have been traded, okay? So each of these bars, boom, 100, boom, 100, boom, 100, boom, 100, boom, 100. And yes, the market can move farther than others. Every bar is not going to be the same exact size. But nonetheless, that is what is going on here. So in other words, one bar might compromise several smaller transactions or one larger transaction because it is going to plot regardless of the size of the transactions, okay? So regardless of the size of the transactions, we are going to plot every 100 contracts, or if we set it to 1,000, it would be 1,000, or we set it to 2,000, it would be 2,000, but you guys are getting the idea. So either way, a new bar is going to begin printing as soon as 100 contracts have been traded, okay? So it should be noted, though, that volume intervals are relative to the trading symbol like we were talking about in the markets that are being analyzed. Okay, so once again, shares will be the word. It'll be 100 shares when we're talking about stocks or ETFs. And then when we're looking at futures like we're currently looking at, it's going to be contracts. Okay, so futures and commodities, it's going to be contracts. And then when we're looking at Forex, it's going to be lot sizes. Okay, so volume intervals are often scaled to the characteristics of an individual symbol because securities that trade a higher volume require a larger interval to prevent relevant, or just to provide, I should say, not prevent, but to provide relevant charting analysis. Okay, so common intervals for volume charts include larger numbers such as 500, 1,000, and 2,000, as well as the larger Fibonacci intervals like 987 and 1597, I think 2,584 as well. So we've got ourselves something where we're generally going to see the numbers a little bit higher on the scale, but once again, it is all relevant to what you personally prefer. But that is just the meat and potatoes there, if you will, what is mostly being used. Those are like the 987, the 1597, and the 2584. Those are very, very common numbers, as well as the 500, the 1,000, and the 2,000, just flat round numbers. But you'll see those Fibonacci numbers come into play quite a lot in all of sides trading, and even in some ways in time-based trading as well. But once again, all right, it is going to be relevant. You're going to have to figure out what it is you're trading to make sense. Because obviously, guys, you don't want to set it to say, if we're trading something that's ridiculously active, say we're looking at like the NQ or something, and we know that the NQ can rip upwards or rip downwards 400 points or something, and it can rip upwards or rip downwards. Maybe we got crazy news going on. If it's something more active than something else, the common sense approach is obviously the one that is more active. We're going to keep the number, the number in regards to the volume itself, the volume interval. We want to keep that number a little bit higher because we don't want 6,000 bars plotted every second. Instead, we want something that's manageable, something that we can analyze without feeling overwhelmed. And if we're trading something that's a little bit slower, if it's an asset that doesn't trade as actively or doesn't move as much, so to speak, then we want to obviously lower that number down because we don't want it to plot just one bar an hour. I mean, maybe you do, but you guys probably get the idea that we're going with that, okay? Now, the next thing that we have, the next option that we have is going to be range, okay? So range. All right, we currently have a series size of 5. And once again, we can adjust this to anything that we want. And just like we did before, we're just simply going to click this cogwheel and go back to the charts. And now we have ourselves some more uniform plotting options. So, more uniform bars in that sense. And this is why. So range bar charts are based on changes in price and allow traders to analyze market volatility in similar ways to the other couple options that we mentioned, much more converse to the time charts that we started off with. So, for example, a 10-tick, I apologize for that, guys. So, for example, a 10-tick range bar chart will print 1 bar each time there are 10 ticks of price movement. Okay, so if all of you are awake now, because I had that alarm go off, we can pretend that I planned that. But if all of you are awake now, once again, the idea is to understand that a 10-tick range bar chart will print 1 bar each time there are 10 ticks of price movement. And in this case, because we currently have ourselves set to 5, what do you guys think that means? That means 1 bar is going to be printed each time there are 5 ticks of price movement. Okay, and once again, we're looking at the Euro Forex futures. So every time we have 5 ticks of price movement, we're going to have ourselves a new bar printed. So if we use some round numbers, something a little bit easier than what we're currently looking at, let's just say we have a magical asset and the number is just say 500.0. Okay, so if we have a new bar that opened at 500.0, in this, once again, hypothetical example, don't look on my charts, guys, because with Euro Forex futures, it'd be a little bit more complicated. We got more numbers involved, so I'm trying to make this easier for you guys. So if we were trading an asset and it was 500.0, okay, where that decimal number represents, obviously our ticks. So if a new bar opened at 500.0, that bar is going to stay just 1 bar. It's not going to print any other bars until price reaches 501.0, okay, or 499.0. So what is happening there? That's created a new bar. Well, we're going 10 ticks upwards to create that new single-digit place, okay, or we're going 10 ticks downwards. So it doesn't matter how much trading goes on in terms of inside the range bar. This is what differentiates it from the other charting styles that we were talking about. In the tick in the tick charts, as well as the volume charts, the range bar charts, once again, they're measuring a distance moved. So there could actually theoretically be a lot of trading that goes on within whatever spread period that we have, even if it's a small one, as long as price itself is not climbing out of that range, it's going to stay 1 bar. So I'm sure you guys are already getting ahead of me here in understanding the value in this. So we can lock in and only pay attention to market moves when it is moving above certain ranges, and we can predefine that with the the time interval setting of the range itself. So that is, or not time interval, I'm sorry, which the interval setting. I don't know why I threw time in there. But nonetheless, okay, so once 10 ticks of price movement have occurred, if that's what you have it set to, if you have it set to 10, in this case, we have it set to 5. So once 5 ticks of price movement have occurred, each bar, as you see down here, okay, each bar will close and a new one will open, okay? And it's, once again, it's once the interval has been met. So once we set a range that is wider than the predetermined number, it's going to draw a new bar. So it sounds confusing, but really it's quite simple. So by default, each bar closes at either the high or the low of the bar as soon as the specified price movement has been reached. Okay. So one of the benefits to using range bar charts, hopefully the market's not range bound. One of the benefits is that fewer bars will print during periods of consolidation. Once again, so in a different way, the range bar charts also make it easy to pay attention to when the market isn't doing much, so to speak, in terms of movement. So once again, the market could actually have a large number of shares or contracts or lots being traded and not going anywhere if there's some type of equal equal pull in both directions. Obviously, if you got the buyers buying and the sellers selling at a very equidistant rate, or a very equal amount anyway, you're not going to see the market you're not going to see the buyers overpower the sellers if they're both doing the same things, and you're not going to see the sellers overpower the buyers. So with the range bar, I keep saying range bound, with the range bar chart, it does make it quite easy to see when the market really isn't doing anything, because you're not going to have any bars being plotted if it's not going up or going down, because we need those ranges that we're setting to be broken. We need them to exceed the number that we have set. So if we have it set to 5 ticks and we need to see a range that is larger than 5 ticks, it'll close the 5 tick range off, open a new bar, and that bar will be open and stay in progress until, you guessed it, another period has pushed outside 5 ticks from that current range. So that is the way that the range bar charts are drawn. And it is the idea here with all of these charts is to reduce market noise encountered with stuff that we end up seeing with the time charts, okay? So with the same information, the range bar charts, they deliver the same price information as time-based intervals, but often allow traders to pinpoint entries with greater precision, arguably because they are able to pay attention to moves and ranges that aren't necessarily illustrated as clearly with a time-based chart. So that's the argument for the range-based charts, as well as really just the data interval trading in general, aside from just time-based charts. So if we recap all the stuff that we kind of talked about, and if I moved a little too quickly here, or maybe that alarm just somehow just sent your mind into some weird hypnotic state and you guys got lost in something that I was saying, I have good news for you all, and that is this is being recorded. So you will be able to play this back at any point in time, and you will be able to watch it as much as you want. So I should have probably told you guys that from the beginning, but sometimes I don't like to give it all out on the first date. So that is a good little piece of information for you if you feel like you missed anything or if I moved too fast. So anyway, but to sum it all up, guys, choosing the right interval depends on your personal style of trading. If you are looking for bigger moves and plan on staying longer in a position, well, we consider larger data intervals. And then conversely, if we trade smaller moves and like to be in and out of positions, then we obviously are going to consider smaller data intervals. Okay, there is no such thing as a single perfect setting that covers every trading style and personal preference. Okay, but it is something that you need to play around with, just like everything else when you first get your trading platform, just something that we should do and get an idea of. Even if you haven't, even if you're set in your ways and you've been trading one way for a couple of years, it is still beneficial, in my opinion, to go ahead and mess around with some of these options out there. Okay, and the bottom line to all this is database chart intervals can be beneficial because they allow market participants to view charts that are driven by factors other than time. So as with all trading tools, these charts must be set to accommodate the market participant's own style and strategy, putting your own little finesse and touch on things. So traders may find it helpful to experiment with different data types and intervals to find the combination that best suits their methodology. And that is really what it comes down to. Now that you understand what tick charts are in relation to time charts, now that you understand what range charts are in relation to tick charts and volume charts, you know all three of those off-brand, so to speak, charting styles that are very popular, even if they're not the most popular. Being the most popular doesn't always mean it's the best option. It might be in your benefit to, pursue experimenting at least with some of these charts and see how you find your views in the market. Maybe you become a little bit more accurate. Maybe it protects you because you are able to more adeptly avoid those periods of consolidation and those periods of low volume. So there's a lot of value here to be had in regards to understanding and playing around and becoming familiar with these different chart types. But guys, this has been a pleasure. I always enjoy doing these weekly Wednesday discussions with you guys, and I hope you all enjoy them as well. And I know I will see many of you very soon, but I am going to close this off at this point in time. This has been a presentation on the top three. Oh, goodness. Look at that. We got ourselves a beautiful Another little ding dong there, keeping us going out with a bang. But this has been a presentation of the top 3 off-brand charting styles. I thank you all for joining me, guys, and I look forward to seeing all of you here. Once again, my name is Chris here at Earn to Trade. I am a mentor, trader, and educator here, so I'm sure I'll see some of you guys very soon. Thank you, everybody. Over and out.